It is 11:14 on a Sunday night, and you are lying in bed, running the numbers for the thousandth time. Nothing has gone wrong, yet you are still there in the darkness, recalculating the same figures you analyzed last week and the week before that. Mortgage, car payments, student loans, and the ever-rising price of groceries are all swirling in your head. You are trying to figure out if this is finally the month you get ahead, or if you will just keep treading water like you have for the past 3 years. Deep down, you already know the answer, but you keep doing the math because the alternative is admitting that this exhausting cycle is simply what your life has become. Meanwhile, your neighbor, who lives on the same street in a similar house and earns a similar salary, woke up last Tuesday and just decided to take the week off. There was no emergency and no stressful email to his boss. He simply did not feel like working, so he stayed home. The truth is, he is not necessarily wealthier than you. He has just stopped doing that Sunday night math. Today, we are exploring something the world of personal finance rarely explains well, which is what actually happens to your bank account, your career, and your mental state the moment you make that very last mortgage payment. I can tell you right now that by the end of this story, those late-night calculations will look completely different to you. When you are 12 years into a 30-year mortgage, no one mentions that you are not just paying off a bill, you are actually ending a prison sentence that you had forgotten you were even serving. Let us look at the numbers because the reality is much more intense than most people realize in both directions. By the year 2025, the average monthly mortgage payment reached $2,329. That figure only covers principal and interest and nothing else. For those who bought or refinanced at more recent rates, $2,845 is a much more realistic number. Now, consider that the median American household takes home about $5,400 a month after taxes and Social Security. This means that a standard mortgage is devouring 43% of your disposable income before you have even bought a single grocery. Every financial expert on the planet agrees that this number should not exceed 28%. Essentially, most homeowners are living 15 percentage points over the safety limit every single month for 30 years straight. You are essentially a functioning adult who has agreed to be financially squeezed in slow motion until the age of 63. Think about a typical family. Let us call them the Garcias, who earn a combined $110,000 a year. That sounds like a comfortable life until you see the actual breakdown of what it costs to simply exist. After taxes and a modest retirement contribution, they take home about $6,800 each month. Their $380,000 house costs them $2,400 for the mortgage, plus $380 in property taxes. Add $200 for insurance and $320 for a maintenance fund, because the heating system does not care if it is the middle of winter. That is $3,300 a month just for the legal right to occupy the building. They are left with $3,500. Then come the car payments at $800, insurance at $240, and gas at $280. Throw in $550 for student loans and $380 for health insurance premiums. Groceries take another $700, and utilities like heat, water, and phones cost $420. They are left with exactly $130 remaining. This does not even cover clothes, the kids' hobbies, medical bills, or a single concept of fun. The Garcias are not being reckless. They do not own a luxury boat or travel to Europe. They are just two professionals doing exactly what they were told to do, but every life decision is now filtered through one silent question. Can we still afford the mortgage? That question is like a browser tab in their minds that they can never close. However, the day that mortgage is paid off, that tab finally disappears and they start making entirely different choices. When that payment vanishes, you do not suddenly have the full amount to spend because taxes and insurance still remain. For a $400,000 home, you might still pay around $838 a month in ongoing costs. But if your payment was $2,845, you have just freed up $2,000 of pure, spendable cash. That amount is absolutely staggering in terms of what it can do for your future over time. If you take that $2,000 and put it into a basic index fund earning 8% annually, the results are incredible. In 5 years, you have $146,000. In 10 years, that grows to $365,000. By 20 years, you are looking at $1,177,000. You only contributed $480,000 of your own money, while the market provided the other $697,000. The majority of your wealth came from compound interest, not from working harder at your job. If you want to master these kinds of wealth-building strategies and finally take control of your financial future, make sure to subscribe to Billy Finance right now. On this channel, we break down the complex world of money so you can stop doing that Sunday night math and start living life on your own terms. Now, some people will argue that if your mortgage rate is low, you are mathematically better off investing the extra money instead of paying off the debt. While the logic of comparing a 3% debt to an 8% market return is clean, it does not account for human behavior. Most people end up spending that extra cash on a better lifestyle instead of actually putting it into an investment account. The mortgage was a form of forced savings that kept them disciplined for decades. Furthermore, it is a very different psychological experience to watch the market crash when you own your home outright compared to when you still owe the bank thousands of dollars. Real research shows that carrying debt actually impairs your cognitive functions and makes you more impulsive. A study found that eliminating debt caused clinical anxiety levels to drop from 78% down to 53%. People literally became smarter and more capable of making long-term decisions once the weight of the mortgage was lifted. The sense of psychological relief you feel isn't actually about the specific dollar amount you save. Think about it like this. Paying off a $3,000 credit card bill often provides a much bigger mental boost than seeing a $5,000 debt slightly reduced. Your brain is less concerned with the math and more focused on closing those open loops that drain your energy. For many people who have spent years battling car notes and student loans, the mortgage is the final open loop humming in the distance. When that last payment is finally made, it is like a loud appliance in your kitchen suddenly turning off, bringing a level of silence you forgot existed. Researchers at Northwestern University have found that high debt ratios are directly linked to higher blood pressure and increased levels of depression. This is not just a figure of speech. Your body physically carries the weight of that financial obligation every single day. The mortgage is not just a line on a spreadsheet. It is a physiological burden that your nervous system tracks. When the debt vanishes, your health actually begins to recover because your body finally notices the weight is gone. Consider how this changes the game for a family that manages to pay off their home in 22 years instead of 30. By eliminating $2,000 in mandatory monthly costs, the total amount of money they need to be financially independent drops by a staggering $600,000. They did not need to get a massive promotion or start a blockbuster business to reach this goal. They simply changed the fundamental cost of their survival. When your basic needs require 2 full salaries running at maximum capacity, you are effectively trapped in your current situation. You cannot afford to leave a job you hate or take a lower-paying role that actually brings you meaning. A 30-year mortgage is essentially an employment contract you signed without realizing how much of your future freedom you were signing away. Recent academic studies show that when people feel secure in their housing, they are significantly more likely to start their own businesses. This effect is particularly strong among women and minority entrepreneurs who often face the most financial pressure. Every single dollar tied up in a mandatory monthly payment is a dollar that cannot be used to take a creative risk elsewhere. Imagine reaching that 22nd year and having that burden lifted completely. You can finally stop asking if a job is stable enough to cover the bank and start asking if the work is actually worth your time. One person can start the business they have been dreaming about because a single bad quarter no longer means losing the roof over their head. Their income might not have changed, but their entire life trajectory shifts because the math of their existence has changed. Now, let us be completely honest about the numbers, because the house is never truly free, even after the bank is out of the picture. Property taxes are a permanent reality, and they have risen by an average of 27% across the country since 2019. In high-tax areas, you might still be paying over $700 a month just to exist on your own land. In a way, your house is always paying rent to the state regardless of whether you owe a bank. Insurance costs have also skyrocketed by 52% recently, as if the atmosphere itself is trying to collect a fee. Plus, you still have to follow the 1% rule, which means setting aside 1% of the home value every year for maintenance. On a $400,000 home, that is another $333 a month, for the inevitable day the water heater dies on a holiday. So, while a $2,800 mortgage might vanish, you are still looking at around $800 to $1,300 in ongoing monthly costs. This means you gain about $2,000 in actual monthly freedom, which can still grow into over $1 million over the next 20 years. Just make sure you plan for those real numbers so a property tax bill doesn't ruin your week. It is also worth looking at who is actually reaching this milestone in today's economy. Roughly 40% of American homeowners are now mortgage-free, which sounds like an encouraging statistic until you look at the ages. The vast majority of these people are over 65, while fewer than 28% of working-age adults own their homes outright. With the average age of a first-time buyer now sitting at 36, a standard 30-year loan won't be finished until they hit 66. Even more concerning is that the amount of mortgage debt held by seniors has increased by 400% in recent decades. We are starting to normalize the idea of carrying massive debt into our retirement years, and that is a dangerous trend for long-term stability. Only 23% of Americans are truly debt-free, meaning they owe absolutely nothing to anyone. When people finally reach that finish line, they describe a level of peace that is hard to put into words. So, how can you actually speed up this process and get there sooner? On a $450,000 mortgage at 6.5%, you will end up paying over $573,000 in interest alone. Think about that for a second. The bank makes more money from the interest than the house was actually worth when you bought it. By simply switching to bi-weekly payments, you effectively make 13 full payments a year instead of 12. This one small change can shave 5 or 6 years off your loan and save you over $119,000 in interest. If you can find a way to add an extra $500 a month toward the principal, you could cut 8 years off the total timeline. These are not impossible sacrifices, but they represent the difference between being free at 55 or waiting until you're in your mid-60s. Once you finally make that last payment, there are a few critical steps you must take. First, ensure your lender files the lien release and sends you the actual deed to your property. It sounds like a boring detail, but you do not want to find out years later that the bank still technically has a claim on your home due to a paperwork error. Second, rebuild your emergency savings before you start redirecting that extra cash into luxury spending. You want to have 6 to 12 months of living expenses set aside to fully protect your new sense of freedom. Finally, start putting that former mortgage payment to work in retirement accounts like a 401k or a Roth IRA. If you invest $2,000 a month at an 8% return, you could see that money grow to over $1 million in 20 years. You did not have to do anything incredibly clever, you just outlasted the bank and gave compound interest the room it needed to work. The mortgage is much more than just a massive monthly expense. It acts like a permission slip you have to consult every single time you want to change something in your life. If you want to leave a job you despise, you first have to check if you can still cover those payments. If you want to start a risky new venture, you have to make sure the house is safe first. If you want to take a pay cut to do work that actually matters, you often find that you simply cannot because of that debt. For most people throughout their adult lives, the mortgage is the invisible hand that shapes nearly every major decision. It is not the only influence, but it is definitely the one with the tightest grip on your freedom. However, when that debt is finally gone, the grip is released. This is exactly what people discover after 22 years of consistent effort. The realization is not just that they are suddenly wealthy, even though compounding interest handles that over time. The real change is that they can finally make choices based on what they actually want instead of what the bank requires. That is the transformation nobody really talks about. But it is the one that matters the most. So, all that math you have been doing late on Sunday nights will not last forever. The people who get to stop running those numbers the earliest are not always the ones who earn the most money. They are the individuals who understood exactly what the finish line was worth and ran toward it with a clear purpose. Thank you for watching. And do not forget to subscribe to Billy Finance for more financial insights. We would love to hear your thoughts on this, so please leave a comment down below. Goodbye for now.